Everyone. I hope you can hear me. So it's a great pleasure to welcome you to today's webinar. Sorry, technical issue. So welcome to today's webinar. My colleagues Thomas, Vera, and Eileen will walk us through the recent trends shaping the European fund industry, as analyzed in this year's edition of the EFAMA Fact Book. The Fact Book has been published today, and it is available on EFAMA website. Beyond providing an in-depth analysis of key development in the investment fund industry, both within and outside Europe, this edition also features detailed reports on the fund markets in 29 European countries. And in addition, it includes a series of info box addressing key regulatory issues that EFAMA is actively working on. I would like to take this opportunity to warmly thank all the sponsors of this year's Fact Book. Their support makes it possible to carry out this important research and to make it freely available to the public. Today's webinar will be divided in two parts. The first part will look at the long-term trends shaping the European fund market. And the second part will focus on recent developments in 5 key areas: the UCITS market, the performance and cost of UCITS, the ETH market, fund ownership, and the global investment fund landscape. This topic will be presented by my colleague from the research team, Thomas, Vera, and Eileen, who have been working quite hard, very hard, on this 23rd edition of the Fact Book. Before we begin, allow me a personal note for those who know me well. I will be retiring from EFAMA at the end of June in a few days, so this is my final Fact Book. The first one was published in 2003, long time ago. I hope you will agree that the scope and quality of the Fact Book have continued to grow over the years, including this year. This is something I'm particularly proud of, and of course, this is a great teamwork. But it's time to move on. So with that, I will now hand over to Thomas, who will begin by highlighting 2 major longer trends currently shaping our industry. Thomas, you have the floor.
Yes, thank you, Bernard. So the first one is a switch towards passive and larger funds. And this is a switch that's accelerating. So the market share of passive UCITS, this is about the UCITS market, has been steadily growing, rising from 11% in 14 to 29% in 24. Especially in 24, it jumped by about 3%, 3 percentage points. So that's a strong growth. And this is thanks to the lower cost, the ease of access, and higher liquidity of ETFs, which are chiefly passive. Then combined with this, there is a shift towards larger funds. The UCITS market, the European UCITS market, is often accused that it has too many small funds, and indeed there are a lot of funds. There are more than 11,000 funds that are smaller than 100 billion in AUM, but 100 million, excuse me. But these only represent about a 3% market share of the full size of the UCITS market. And this market share has been steadily declining from 6.5 in 14 to just above 3. On the other hand, the very large funds above 1 billion and up to 10 billion, and especially funds larger than 10 billion in AUM, have been steadily increasing in size. Over to Vera.
Thank you, Thomas. I will be discussing the costs of UCITS in recent years. EFAMA has published quite a few research articles on how the costs of UCITS have been declining in recent years, and this is indeed the case. We're seeing it every year. So the average cost of long-term UCITS, therefore, is consistently decreasing, and that's the case for both active and passive funds. And this is due to the increased transparency of fees, but also intensified competition among fund managers in terms of fund fees. Now, if we break the long-term UCITS into different categories, we can also see individually how these costs are decreasing. For example, for equity UCITS, they went down from 2020 to 2024 from 0.95 to 0.75%. For bonds, this decrease was slightly less pronounced, but then multi-asset also decreased by 10 percentage points. Money market funds, on the other hand, have edged up a bit in terms of fees, but they still remain much lower in terms of their cost compared to other UCITS. I will now give the floor to my colleague, Eileen.
Thank you, Reha. So a third long-term trend is the increasing internationalization of the fund industry. Funds domiciled in the EU are distributed and sold domestically and internationally, both within the EU and to investors outside the EU. What we have been seeing for a few years now is investors outside Europe are becoming increasingly important clients, and this trend continued in 2024. Cross-border funds sold outside the EU surpassed both domestic funds sales and cross-border funds sold within the EU in 2024, just as they did in 2022 and 2023. If you look at the chart on the right, you can see how this trend has changed over the past decade. The share of domestic funds has steadily declined, and the shares of both types of cross-border funds have increased. In recent years, the market share of cross-border funds held within the EU started to stabilize. The share held outside the EU, on the other hand, continues to grow steadily, especially in 2023 and 2024, driven by ongoing strong investor demand. This highlights the success of UCIT as a truly global brand. UCIT are sold in over 50 countries beyond the EU, making it a very successful financial export product for the EU. Now over to Thomas for a look at what happened in the UCIT market recently.
Thank you, Helen. So the main focus of the fact book is always what happened in 2024. So there we had actually very strong inflows into bond funds, 275 billion, thanks to the ECB cutting interest rates and investors anticipating further easing in 2025. Money market funds also saw very strong inflows, record net inflows actually. And that is because the yield curve was inverted for still much of the year, meaning shorter term debt securities had a higher interest rate on longer term debt securities. And also this is sort of a reaction to the uncertainty, as money market funds are often used as a cash-like alternative by investors. Equity funds saw a rebound in 2024 from a low level of sales in 2023 as stock. Okay, a bit back, Bernard. I wasn't done yet. As stock market sort of recovered. On the other hand, money market multi-asset funds saw net outflows for the second year in a row. If you look at the asset growth, we had about a 16% asset growth in the UCITS market. This was the third largest of the decade. And here the chart on the right-hand side breaks it down between the effect of the net sales, so the sales, and the net effect of the market appreciation, how the market effect played. And in 24, we had about, of that 16% growth, there was about 11% that was attributed to the market appreciation and 5% to the net sales. Now, maybe if we go into the equity market? Yes. So if we look deeper into the equity UCITS, we focus a bit on which fund types were the top sellers and which attracted the bulk of the net inflows. And there were two types that have been attracting all the net inflows in the equity UCITS market. And those are global funds, so funds investing globally, often tracking a global index, and US focused funds, often like following the S&P 500 or so on. These have account for all of the net inflows in 24, just like they did in 23. On the other hand, European focused funds saw net outflows, UK focused funds saw net outflows, also all these sector specific funds focusing on specific sectors, financials or more thematics on net outflows. Global emerging market equity funds also saw net outflows. A result of that is that the share of US stocks in the asset allocation of equity UCITS rose to above 50%. It's a combination of indeed these strong inflows into those those US-centric and global funds, which often are heavily weighted towards towards US stocks, and the stronger performance of US stocks in those recent years, 23, 24, specifically US technology stocks. 25 might be different there, as we see that European stocks have performed slightly better, but we'll see what that brings there. If we look at the bond UCITS, there we had almost inflows across the board. All types of bond UCITS saw inflows, the government and corporate ones. Also, the more risky some of the more risky segments of the bond markets that had outflows in 23, like high yield bond funds, saw net inflows. A category that did particularly well were the ultra short-term bond funds, which have a maturity of less than 1 year, also taking advantage of this inverted yield curve there. There were only two segments that did less well. There was the inflation-linked bond funds, which really fell out of favor with investors, since in 2022 they failed to protect investors from the bout of inflation we had that year. So since then, they're really out of favor with investors. Emerging market funds also, bond funds also saw net outflows. On the right-hand side, you see the asset allocation by bond maturity. And there we had this growth in the short-term maturities from 2020 from 7% in 2020 rising to 12% in 2023. So the maturity is less than 1 year. This trend appears to have halted a little in 24, as sort of yield curves returned to normal and shifted back from inverted to normal. If we go to the multi-assets UCITS market, there, as I mentioned, we had net outflows this year, minus 40 billion, slightly better than the 120 billion of net outflows in 2023. But still, it's the only 2 years of net outflows of the decade. And there are a few reasons why they fell out of favor. But the main reason here is that they failed to shield investors from a simultaneous decline in what are typically uncorrelated asset classes in 22, bonds and equity. Normally, if equity stock markets go down, bond prices go up. For reasons we discussed before, both valuations went down in 22. So investors were sort of disillusioned with this type of funds, and they disinvested from it. They're also slightly more expensive than bond and equity UCITS. They don't have ETFs there, which have been doing very well. So those are also part of the reasons. If we zoom into what type of multi-asset UCITS accounted for the bulk of net outflows and where we still see inflows, it was mainly the more defensive and balanced allocations that saw net outflows. This means that they had a higher share of bonds in their asset allocation. probably because their bond investors seeking more safe investments were moving into bond usage, not multi-assets usage. The two segments that still saw net inflows, even though small ones, were aggressive allocation, which has a higher percentage of equities, and target date funds, which target to give a specific return by a specific date. So they're more long-term focused. If we look at the ETF market, so ETFs had a record-breaking year in terms of net sales in 24. They had a record in 23 and then another record in 24. If we look at the equity markets, so the equity ETFs, which performed well, it's the same as the equity slide I showed, the total equity market slide I showed a bit earlier. It's global ETFs, large cap, and US large cap, so tracking MSCI World, S&P 500, that accounted for the bulk of net inflows. Even though here in ETFs, it was also the European-focused ETFs that saw net inflows. In the bond market, there were also inflows across the board, government bonds, corporate bonds, high-yield bond ETFs. The highest actually inflows in the bond market were these ultra short-term bond ETFs, which again, taking advantage of those higher short-term interest rates. If we break down the net sales of long-term UCITS, and this is we see here in the equity market, and this is the same trend we saw last year. We saw that all the inflows into equity UCITS were actually due to ETFs. The non-ETFs, so mainly the active funds, even though there are of course some active ETFs now, but the market is still small. The non-ETFs saw actually net outflows, just like they did last year. It's different in the bond market, where the bulk of net inflows are still in these non-ETFs actively managed bond funds. What happened in the sustainable funds? They are facing a bit of headwinds. So as you know, we have this division in the Sustainable Finance Directive breaks up the market in Article 6 funds, Article 8 and Article 9 funds. Article 6 funds are the ones without any sustainability criteria. Article 8 have some, and Article 9 have like stringent sustainability benchmarks. From 22, when we had overall outflows in the whole market, and Article 9 funds proved to be quite resilient, still drawing net inflows. This situation has completely shifted. And now we had mainly Article 6 funds and Article 8 funds that saw all of the net inflows, and Article 9 funds actually turned negative. If you look here on the right-hand side, this is just the long-term UCITS. The difference being that a lot of Article 8 funds are actually money market funds. So a big chunk, if you see the difference here between the total and the long term, are Article 8 money market funds. So why did we have these outflows from Article 9? It's partly that there are multiple reasons. There is returns, there is slightly higher costs sometimes. The returns were not good, but it's also because ETFs and money market funds have been very popular in 24, and the bulk of Article 9 funds are not ETFs or not money market funds. Over to Vera.
Thank you, Thomas. I'll be presenting the recent trends and recent research of EFAMA in terms of cost and performance of UCITS. Now, it's important for me to mention that the data that I will present now and the research comes from, for example, 2 fact book boxes out of 10 that we have in our fact book 2025. So I invite you to read them. They give a very nice overview of the recent market trends as well as regulatory developments, and they are developed by us and our colleagues. Hard work invested, and I'm sure you will enjoy them. With regards to the performance in 2024 of UCITS, and when we ask ourselves, have UCITS delivered in 2024? The short answer is yes, very much so. Equity UCITS gained, for example, 18.1% in 2024, thanks to robust, strong markets, despite the challenging conditions and sticky inflation that we witnessed. Bond UCITS also returned 6.5% since yields stabilized, thanks to the central bank signaling that they are slowing down or halting the interest rate hikes. On the multi-asset fund side, they averaged 9.8% in terms of average net performance in 2024, compared to the, for example, 5-year average of 3.7%. And then finally, money market funds also showed very strong returns, 7.8% in 2024, compared to 2.4% in terms of 5-year averages. What's important to mention here is that we're looking at the 2024 calendar year average net performance. We cannot not ask ourselves, so what happens this year, given the geopolitical tensions and all the uncertainty that we are seeing and facing? In the fact book, in the fact book boxes, we do also talk about the performance in 2025 until the point of the publishing of the fact book or in times of writing. And what we're seeing also is that indeed, there is uncertainty. There is much more volatility this year. For example, the strong momentum for 2024 actually continued in the early 2025, but in early April, given the increased geopolitical tensions, as well as the sudden shift in the US trade policy, there was a very strong market correction. So, for example, on the 3rd and 4th of April, Nasdaq Composite Index lost 12%, and then, for example, Eurostoxx 600 lost 8%. But only, for example, 4 days later, Nasdaq Composite Index gained in one day 12%, which is the highest daily increase or highest daily return in the last 2 decades. This shows us that actually volatility cuts both ways. Very interesting also trend that we are observing is that in 2025, actually European equities are doing better than the overall global and US equities. This is due to the skepticism over US tariffs, to the overvaluation of US stocks, but also the growing optimism around European commitment to increasing its competitiveness. We will see whether this trend will continue, but we are maybe seeing a shift, not only in where the returns are being generated, but also maybe in general allocations of investors' investments geographically. For example, up to today, 24th of June, based on Market Watch, you still see positive returns in the calendar year, so year to date. For Nasdaq Composite Index, it's 1.66%, and in terms of Eurostoxx 600, it's 5.4% in terms of net performance, so quite higher. We will see what happens next. Clearly, we are witnessing very increased, let's say, the era of increased uncertainty, geopolitical tensions. But what remains to be said is that investors that focus on diversification and long-term approach to investing are still well positioned to benefit even from rebounds, and generally are able to weather the storms that we are seeing. Now, given that I've been until now talking about average net performances 2024 and up to 2025, I do need to say that there is a deceptive power in averages. If you are an investor, you are not buying an average. You will buy a fund that might be performing below the average or above the average. And therefore, we have also studied the overall variety of performance inside UCITS groups. So what you're seeing now at the screen are 4 charts of density distributions, where we are analyzing for equity UCITS and bond UCITS, how wide the net performances were in 2024 and in the 5-year period from 2020 to 2024, which are the charts below. For those who are not introduced to density distributions, this little hill simply shows all the funds that reported performances in 2024. So, for example, if you look at the upper left chart, these are active equity UCITS. If you bought an active equity UCITS in 2024, you could have had a net performance of -10% or +40%, depending on which fund you chose. So why is this the case? The case is that the funds are simply extremely different in terms of their investment strategies, in terms of geographical, sectoral allocations, risk profiles, and so on. So therefore, it is important to keep in mind that the averages are not correctly representing the overall universe, and that the story is much more complex behind. This leads me to my next slide that shows how important is to when investing for investors to choose a fund that aligns best with their investment preferences, given this wide variety of funds that we are seeing. Very often there is a discourse saying, okay, you go for the cheapest funds and then cheapest fund, and then you will simply have the highest net performance. So we wanted to inspect that. So initially, when you're choosing a fund to invest, we have plotted a scatter plot on the left side of the slide. The upper chart is for equity, the lower chart is for bonds, of average annual ongoing charges versus annualized net return in the last 5 years. What we're seeing is that there is no clear, strong, significant negative correlation between the two. It does not necessarily mean that at the beginning, if you pick the cheapest fund, that you will have the highest net performance. There are so many other factors involved, and that goes for active and passive UCITS equally. So what are these factors? They're exactly all of these factors influencing the wide variation of UCITS funds that I've explained. Investment strategy, allocations in terms of geography, strategy, market allocations, risk profile, sustainability characteristics, and so on. We even look inside of these smaller universes of UCITS where we divide them in terms of sectoral allocation, geographical allocation, for example, energy equity, technology equity, then according to geography, European equity, global equity, or European bonds, global bonds, and so on. And we notice that among them, the net performances are very different. But inside of these categories, even active and passive UCITS have similar performances. They are more similar than actually active UCITS across different investment categories. So it's not even the fund type that will determine the actual final fund performance. What is the rationale behind? The fees do matter, but only once you have actually chosen as investment strategy of the fund that you would like to invest in. Therefore, it is important to either obtain professional investment advice or read key information documents of funds to be fully informed and align your investment with your investment preferences in terms of risk level, sustainability, geographical sectoral allocation, but not primarily and immediately in terms of cost, because other factors are influencing the performances as well. I will now give the floor to my colleague Eileen, who will explain to us the recent trends in the IF market.
Sorry. Thank you, Reha. So I'm going to presenting what happened in the IF market. Well, sales were still relatively muted. We had 55 billion euros of net sales compared to 53 the year before. They are still a bit impacted by the trend we've been describing over the past few years, from 2021 to 2023, especially in 2022. Net sales of IFs were impacted by large outflows in the Netherlands and, to a lesser extent, Denmark. This trend continued in 2024, but it has slowed down. This was the decision made by large Dutch and the Danish pension funds, moving out from IF wrappers to segregated mandate. It's more of the structure change than a loss of asset. So the assets are still being managed by the same asset managers. They are just being held in a different legal structure. If you look at the chart on the right, it displays the types of funds that performed well in the ETH sector. We see a different picture compared to UCITS. We have negative sales in equity funds. This is related partly due to the Dutch and the Danish outflows. Bond funds did well. That's consistent with UCITS. Multi-asset funds, it did actually quite well in the ETH sector. This is related to the special funds in Germany, which are often classified as multi-asset funds. They invest in different types of assets and still did quite well. Real estate funds were negative for the first time in the decade because of the drop in housing prices we had last year. Last slide. Next slide, please. Thank you. So some of the long-term trends in the ETH market. This is one of the new charts we wanted to show. It highlights the rise in the share of closed-ended ETH asset in the total ETH market. In 2024, the share has more than doubled compared to 6 years ago, increasing from 9% in 2019 to 21% in 2024. And we think this is driven by increasing investor interest in private market, which is where closed-ended funds usually invest. When we look at countries, investors are increasingly making use of Luxembourg reserved alternative investment funds to invest in these asset classes. If you look at the chart on the right for the asset allocation of ETFs, we do see a steady increase in the share of investment funds held by ETFs. And to us, this is a clear sign that asset managers are using ETFs and other passive funds in their asset allocation. It's also an easy way for them to get some geographic diversification of their asset and better manage risk. Now over to Thomas for some insight into who is investing in European funds.
Yes, thank you, Helen. So who are the main investors in funds? In Europe, for a long time now, we have three main investors. We have the insurers and pension funds, we have the households, and we have the long-term funds. So these are funds investing in other funds. They're grouped here like this because this data is sourced from the ECB, and they're labeled as a specific investor category. So what we're seeing is that insurers and pension funds, who were traditionally the largest fund investor in Europe, have seen their market share slightly decline. On the other hand, long-term funds have seen their share gently rise over the past years. This is because what Helen mentioned earlier, that these fund managers are often using ETFs in their portfolio management to gain an easy geo exposure or to gain a sectoral exposure. But encouragingly, we also see the share of households edge up since 2020. So it went from below 25% to almost 27% in 2024. And these trends are supported by the net acquisitions we see on the right-hand chart, where even in 2022, which was a bad year for funds, we had overall outflows. We still had almost 90 billion of funds being bought by retail investors. Same here in 23, retail investors bought almost 100 billion of funds in that year. In 2024, retail investors bought almost 260 billion of funds. So they were the largest buyers of funds that year. And this is quite encouraging, actually, for us as a sector, but also for households themselves, because they are investing in funds and they're getting a better return. What's also interesting is the steady fund purchases by non-financial corporations. So these are non-financial corporations investing in funds. It's often French corporations using money market funds to do their cash management. On the other hand, yeah, so fund purchases by insurers and pension funds have been close to zero in recent years. We look at the next slide. There, this is also a new chart. It shows, it breaks down if these investors, those sectoral investors invest in funds, where are those funds domiciled? Are they domestic or are they cross-border? So of all the funds owned by European insurers and pension funds, what percentage of those funds is domestic? So German funds by German investors, German pension funds, insurers buying German domiciled funds, or is cross-border? What we see here is actually that for the insurance and pension fund sector, the share of cross-border funds is relatively low. And this is because you have a couple of very large countries, mainly France, Germany, and the Netherlands, which has a very well-established domestic, either insurers or pension fund sector. In Germany, you have these Spezialfonds, you know, these funds tailored for specific investors that are usually domestic funds set up for one or a few specific investors. In France, you have these funds set up for the insurance sector. In the Netherlands, you have the pension funds that mainly invest in domestic funds. But the share has increased in recent years. It grew from almost by 10%. On the other hand, on the right, you see the same shares by the household, so the retail investment sector. And there you see there always has been a larger share of cross-border funds. And even though it's been large, it's still been gradually increasing in recent years. This underscores the effectiveness of the UCITS passporting regime in facilitating the distribution of funds. And also it shows the increased demands of ETFs, what I mentioned earlier. ETFs are in Europe are mainly domiciled in Ireland and then to a lesser extent Luxembourg. So if you buy them out of Ireland and Luxembourg, you will buy a cross-border fund. Of course, there are big differences here across countries. It depends also on the structure of domestic fund markets. Like for example, in Italy, retail investors buy almost 70% of their funds are cross-border, because Italian fund managers have this round trip setup where they set up their funds in Luxembourg and then just sell them to Italian investors. On the other hand, in Poland, for example, the share of cross-border funds is only 4%, since that their asset managers are still very much focused on their domestic market. But overall, the main message probably on this slide is you see these increasing percentages of cross-border funds, and they do show that the single capital market in Europe is growing and is deepening. So that's sort of an encouraging message. Now we look at the retail investors. So here on the left-hand side, you see the total financial asset acquisitions by household. So where they invest their money in financial assets, disregarding the real estate they buy or other material assets. And then we see actually they've mainly invested their money in their deposits. But from 2022, when they invested the vast bulk of their savings into deposit, this has actually declined to a record low in 2023 because of inflation, which and the sort of the lower rise of the reluctance of banks to raise interest rates up until now, sort of pushing investors also into exploring other instruments. And the main way retail investors normally access the capital markets is via investment funds. 2023 was an exception there, since there retail investors bought a lot of debt securities. This was because in a few countries, Belgium mainly, but also Italy and Spain, Germany, there were domestic bond issuances by the government specifically aimed at retail investors, often with some sort of a tax incentive. And especially, like for example, in Belgium, they did this bond launch to sort of stimulate banks to increase interest rates a bit. And this was very successful, as you can see there were very strong inflows into debt securities. 24 saw this trend reverse. A part of these debt securities, the money invested in these debt securities flowed back into deposits, but the chunk of it flowed back into investment funds. We actually had the second highest investment in investment funds of the past 6 years. So that was strong investments. If you look at which countries households were mainly investing in funds, Germany is the top here, almost 100 billion of funds bought in Germany. Then we have Spain, 46 billion. Turkey here, Turkey is a member of EFAMA, even though they're not included in the ECB data. This data was sourced from OECD. Why did they buy so much funds in Turkey? It has to do with the geopolitical situation there. You had lots of exchange rate fluctuations. You had a sprout of inflation. What they mainly were buying were money market funds and this ARIS funds, these absolute return funds, which sort of guarantee a return. So they were trying to protect from the sprout of inflation there. Also, Italian investors were really buying funds in Switzerland as well. Then the usual suspects, France, Sweden, Poland as well. Greece enters the top 10 again as one of the 10 largest buyers of funds there. I think now we leave it to Helen to quickly go over what the global markets have been doing.
Okay, thank you, Thomas. So the last part is a quick look at what happened in the global fund market. We saw a new record in net sales, 3.5 trillion euros globally, driven mainly by strong inflows into money market funds and bond funds. Equity funds also performed well. Similar to the UCITS market in Europe, there were outflows from multi-asset funds globally. From the chart on the right, we can see the record flows were mainly pushed by US and also record flows in the Asia Pacific region, thanks to strong net sales in China and Japan. In Europe, net sales of European funds more than doubled. However, just like the year before, net inflows into Europe were lower than those into the Asia Pacific region. Now over to Thomas for the last slide.
Yes, here we just wanted to show the difference between trends in Europe and in the US. And I mean, we discussed Europe at length, so I won't go into detail there, but what we wanted to show is these absolute record net sales of money market funds in the US, both last year and this year. This all started with the collapse of Silicon Valley Bank in March 2023, which sort of shifted US retail savers to move part of their deposits into money market funds. You really have like a lively market for retail money market funds in the US. In fact, a market that doesn't exist in Europe, unfortunately. And that was, of course, combined with sometimes very attractive interest rates. You have interest rates up above 5%. So retail investors were really moving into these funds. 2024 also saw pretty solid inflows into bond mutual funds in the US. This was because the Federal Reserve finally started to lower interest rates there. I mean, like I said, the European flows have been discussed at length, so we don't need to go into that. Maybe we can shift to some questions.
Yeah, there is one question in the chat. So
Very
please
good.
use the chat just to ask the question. But thank you, Regina, for your first question regarding the flows towards larger funds. Indeed, I mean, as explained by Thomas, this is a striking development in Europe with now 25% of the funds that have AUM greater than 10 billion. So I think this reflects a degree of competition in the market, driven by the cost and the fees of the fund and their returns. We haven't, dive into the analysis of these in details, but your question suggests that we should be doing that. We anticipate that also the success of ETF and index tracking funds, can explain in part this increase. So if we would just, we would be looking at the distribution of these large fund among active index and ETF. We believe that we would find a greater number, let's say, of passive funds. Another comments on this regarding the impact, and that shows that it's widely recognized that an increase in size help asset managers to reduce fee. So there is their correlation, and we have a number of market insight that analyze and confirm this result. Secondly, another comment that comes through my head is that Europe is often criticized for having way too many funds, and therefore the average size of the funds is small. But if you look at the average size of active funds, active equity funds, is less than 500 million. But again, as Vera said, I mean, the average it's a very useful number just to look at. But the reality is that today in the market you have many funds that are big and much bigger than this average. And this is maybe an alternative approach, a positive development, because to the criticism that there are too many funds. But what can we do about this? It's rather difficult. The fact that there are many funds in Europe is part, a legacy of the fact that UCITS initially started in the local markets. And then, as we have seen, the cross-border funds, became larger and larger and more successful. But you still have, many local funds in each European markets. So that's this situation that explains that if you look at the average, it's rather small. And we don't anticipate, even though I think the number of funds tend to, in some countries, even to fall, and not so much, and the increase remain moderate. We don't really think that the best approach to increase the average size of the fund is to expect that the number of funds in Europe and the number of UCITS would decrease. What we would hope, and this is part of the SIU program, is that the assets, the flows that are going into UCITS would increase, and would make those funds that are now larger than 10 billion even larger in the future. So there, it's one of the reasons why we are confident that the SIU, if the measure proposed by the Commission are being implemented, in particular in the pension area, would help increasing the average size of funds in Europe. If you compare with the United States, I mean, one of the reasons why the funds are so big in the United States is that because they are mostly used in 401k and RIAs. This is which is not the case in Europe, because in most countries you don't have funded pension system. So if Europe, along the line of the vision proposed in the SIU, could move closer to a funded pension system, we would see this trend towards larger funds further increase in Europe, to the benefit of investors, because this is reducing cost. So we should all look at the, but there is a
Yes.
question on the asset-weighted cost of usage. Could you, but indeed, I mean, it's quite clear that the asset-weighted cost of usage, is lower than the simple average. If we look at simple average versus asset-weighted, but the difference is not so huge. The difference start to increase. The difference between the two is not so huge and much smaller than the United States. Why? Because yes, we still have, I mean, the market, the fund market, even as we've seen, the fund market increased a lot over the last decade, but it's still much smaller than in the United States. And in the United States, the success of the ETF, passive ETF, has been just so big that some of those funds are so big that the the weighted cost of US mutual funds is much smaller than the simple average. It's a striking finding of one of our research. If you only look at the simple average cost of usage and mutual funds and US mutual funds, they are about the same. We often say that, US funds are much cheaper. There are funds that are much cheaper in the United States, in particular because they are very big, in particular because they are passive. But at the same time, if you look at the whole population of funds and look at the average, the simple average, it's about the same between Europe and the States. So just to generate much lower fees in Europe, we need to have more investors into usage via pension funds in particular and pensions product to increase the size of these funds and to give more possibility to fund managers to reduce the cost.
Thank you, Bernard. Maybe I would just add that for all of our analysis, we mostly focus on asset-weighted measures, particularly for returns, just to show the real state of the market. But at the same time, we always do a parallel analysis in terms of simple measures, just to make sure that what we are concluding is robust, and if there's a difference, why they differ. And then in terms of cost components themselves, we are still not very good in terms of data availability to make such an analysis. So we are working on that, but sometimes despite our wish to provide further insights, we are limited with what data we can have access to.
Any other questions? Just share again this slide so that are we going to make available, there's a question, the slides after the recording? Yes, the answer is yes. So you're going just to get this. As you know now, the fact book is it's more than 300 pages. Right? So it's available online on our website. And we also have published a brochure, printed a brochure with the key findings. But this is just, for us in Brussels. But if some of you are coming to our office, we'll be happy to give you a printed version with the key findings. But, this presentation is a very good, I believe, summary of the content. But don't forget, if you're interested in regulation, also just to look at these info box, because they are really have been written by our colleagues from the regulatory team. On which we are working, so they are just up to date and analyze current issue that are being discussed in Brussels with the European Commission, the European Parliament, the Council. I think that there is no other questions. So
maybe we can just say, if anybody still can think of other questions, feel free to just send us an email after, or email addresses at the last slide. So don't hesitate to get back to us if you've any other questions. We'll be happily take them and answer them.
Very good. So thank you, Thomas. Thank you all for attending this webinar. Our next major report will be the asset management report which is covering not just the fund industry, but also the mandates, and which is looking at where those assets are being managed, which is not a perspective that we take with the fact book. It will be published in December, and in the meantime, we still have in the pipeline a series of market insights that will be some published in July and others in September. So stay tuned, because we are doing this research in particular for you to at least to help you understand with us how the fund market, the asset management industry is evolving. So thank you very much for participating in this webinar, and we wish you a very good end of day.
Thank you very
Thanks
much.
a lot. Bye.
Bye.